May 24th, 2024. We started with the day off with a big gap up. And whenever you get a big bear trend day, the next day you have a 75% chance of 2 hours of sideways to up trading and a 50% chance of some follow through selling on the open. You could argue that bars 4 and 5 were the follow through selling on the open. And you can see we ended up with a wedge on bar 2, 8, and 12. And when you get a wedge and you break out above it, like we did 16, 17, 50% chance you go for a measured move up of the wedge and 50% chance the breakout fails. And we got within one tick of the measured move, which is, it's generally enough to consider it tested with by getting within one tick. So good enough for the bulls. Bar one, after a big gap up, we get a follow through bar on bar one. It's not a very good follow through bar, but it is still follow through in basically a bull doji. But you know that this is strong enough for some sort of second leg sideways to down. My one thought coming in today was that we probably would close this gap right here. I thought it was pretty likely, and I thought that's what we were trying to do here. And you can see we ended up failing. A lot of times, you can know that a magnet is probably going to get tested, but you're never really going to know the path that the market's going to take to get there. So you can see there was a lack of energy trying to get up to the magnet, and traders gave up on it, and that's what caused this. But anyways, bar two, a bear bar closing near its low. If you're selling below two, you're betting that bar one and the big gap up were both a bull trap. However, once you got the big gap and a follow through bar, it made it a lot more likely that this was that we're always in long, and so you don't really want to sell bar two, trading range open. Bar three, it tests back up to the high of bar one. Whenever you have something like this, you should be expecting a trading range open where you're getting reasonable reversal bars. So you got bar one, and it wasn't a good buy, but after a gap up and a follow through bar, it's theoretically always in long, and you get a reversal down on bar two, which again, it wasn't a good sell below two, but it was probably somewhat reasonable. So the traders who take bar one and scale in lower below two are probably going to be able to get back out at their entry price, which they were able to on four. And the traders who buy below two and are willing to scale in above bar three, they're probably going to get out as well. So when you see this trading range open, we're probably not going too far down because we're probably going back here. But then when you see bar three, a double bottom with one, you're hoping it's the low of the day. But we're probably not going too far up because we're probably going back down here. And then, kind of the same concept on bar four, right? So we have an outside down bar four. So bar three, a double bottom with one. Bulls want the move up. Outside down on bar four. But do you want to sell below four? Not really. I think this is a trading range open. And if it is a trading range open, we'll probably get back to this price. Follow through for the bears on bar five. It's a good bear bar closing near its low. Are we always in short? Maybe. But I think that if we are always in short, it's trading range always in short. And so we're probably going to get a reversal pretty soon. I think to make the market clearly always in short, the bears need bar six to also be a bear bar. And so they need one more bar. Usually when you're in what you suspect to be a trading range and the one side needs one more bar to make something true, they're probably not going to get it. And that's exactly why we get a reversal up on bar six. Bar six is a high two on the open. You could argue it's a high three because bar one and then pull back. Bar three would be the high two. But I look at bar one as more of follow through from the gap. And I thought bar three was more of a high one in the double bottom. So I think I look at bar six as a high two on the open. But I'm sure it's not wrong to look at it either way. You can see, a little more than a 50% correction from the gap up. So reasonable buy above six, taking a chance that it's the low of the day. Sometimes on bar seven, you get some sort of news report and the market moves really quickly. I don't really think you would have had time to buy above six. I think, I can only go down to a 1 minute chart on this, but I think in the first 10 seconds of the bar, it rallied really, really far. So I don't think most traders had a chance to get filled. And even if they were able to get filled, yeah, you can see here, this is the 1 minute chart. So in the first minute, it made the high of the bar. And for most traders, if you bought above six and we rallied all the way up to here and, you made 10 points, you were able to make 10 points buying above six, then you're probably just going to take the scalp and be done with it. And that's what a lot of traders did because you got to think about it. If you're 1 minute into the bar and it's all the way up here, what do you think is going to happen in the next 4 minutes? Do you think it's going to become a bar that's closing all the way up here? That's not as likely. It's I don't think that's all that common. So it's probably going to be more of a sideways bar. Bar seven, a bull bar closing around its midpoint, a little bit above. And you can see we're forming an expanding triangle open. And something that's interesting is this gap, right? I thought this was going to close. So we needed to get within here. And if you were going to buy the close of bar eight, where would you, or bar 7, where would your stop need to be? It'd need to be somewhere down here. And if you look, the buy the close, or it would probably need to be below 7. So like here. If you bought that close, you can see you get pretty much exactly 1-to-1 trying to get to this low, maybe slightly better than 1-to-1. And you probably have a 60% chance of that happening before we get down here, us getting here. So a lot of traders, probably one of the reasons why bar 7 sold off to the price that it did, because it needed to create a reasonable equation for bulls to buy the close of bar 7, trying to close that gap. Bar 8, a doji bar, a bear bar, but really not all that good follow through. If you're a bull and you had bought the close of 7, you wanted follow through, and you did not even get the minimum follow through on bar 8. You instead got a bear bar. So that's really not very good for the bulls. And that's probably why there were sellers above 8 instead of buyers, because it was not even minimum follow through. 9, a bear bar closing somewhat near its low. You can see it's a micro double top with 8. Would you sell below 9? I probably would not sell below 9, but we might have to trade below it. Bulls might have to exit below it. It is consecutive doji bars, and we're going to get a second leg up from 6 and 7. So I'm not really sure that you have to exit below 9, but it's early in the day, and the market can make some pretty big moves early in the day. And if you bought the close of 7, this is not what you wanted out of 8 and 9. So I think it makes a lot of sense to just get out below 9 if you were long. Instead, you get 10, a bull bar closing near its high. Do you buy above 10? I think it's a credible buy. You want a bounce trying to get close to that same gap again, but you probably wait and see the follow through first. Additionally, the probability is not as awesome as you want it to be. So some traders look to buy a pullback. I don't think we got back. Oh, we did. So we got to the 50% pullback of bar 10 because traders, they didn't want to buy directly above 10. They would have had to put a stop down here and they'd be risking essentially 7 points trying to make less than 7 points. So instead they bought a pullback. So now, you buy the 50% pullback. Well, now you're risking 3 or 4 points trying to make like 8 or 9 points. And that's a much better equation. So traders, rather than buying directly above 11, bought the pullback of 11. Bar 12, more follow through for the bulls. It's a tight bull channel, which is good. Really tight move up from 6 to 12 and a micro channel for the bulls. But how strong, or how strong are the past couple of bars, 11 and 12? To me, those look more like trading range bars. And the fact that 7 has a huge tail on the top does not help the bull case. I think that also makes it a bit more likely that we're going to start to go sideways here. I just want to say something about the day in general. We got a rally. I had mentioned that I thought traders were going to fight over the open of the week, which was right here, I believe. It's 328. And, usually there's about whenever you get a strong spike on the open, 60% chance you're going to go sideways the rest of the day, 40% chance you'll get, or 20% chance you'll get some sort of trend up and 20% chance you'll get some sort of trend down. But this was one of those days where we had a strong rally on the open, and that was more or less, that was the most tradable move of the day for sure. So good follow through for the bulls on 11-12, but really, actually, I shouldn't say good because it really wasn't all that great with the tails on the top. They were bull closes, but it definitely could be better. And then you get a doji bar on bar 13. Traders who were holding here, they were hoping to get to the magnet. They weren't hoping we were going to get some big swing up. The market would need to get a lot stronger in order for that to happen. However, the trader's equation at this point is not very great to be long, considering the magnet is so close. We might have to get to it, but I'm not really sure how quickly. And then the doji bar, inside bar 13, is usually the end of the trend. So whenever you get a doji bar in a buy the close trend, it usually means the rally is going to come to an end within a couple of bars. And so bulls recognize something is wrong, right? If you're long, why are we not racing up to the magnet? If you thought we were going to get there and we were pretty certain of it, then why is it not going there? It should be more bullish. You should feel urgency, like the urgency you see 17, 18, 19, etc. That sort of urgency. But instead, you get a doji bar. So what do traders do? They see the doji bar and they say, I'm not really that interested in being long anymore. And they think their premise might be wrong and they just exit at the market. And that's what causes bar 14. Do you exit below 14? You probably can, but I don't think you have to. Some traders will stay long. But if you're staying long, it's a bit of a dangerous game because we could get a pretty uncomfortable pullback. We're definitely going to test back to the bar 12 close at some point since it was a tight channel up and a micro channel. So this first reversal down is probably going to be minor. Additionally, strong bear trends do not start with doji bars like bar 13. So if you're going to, if you're looking for a trend, you want to look to buy above a strong signal bar, 6 or 16, rather than, some sort of sell below some sort of doji bar, hoping it turns into something, right? You can see over here, strong signal bar, and we ended up getting a big move down. I believe I'm going to make my review of this day tomorrow morning, but if I don't, it'll come out this weekend since it's Memorial Day, and I wanted to do on Monday anyways. So 15 follow through for the Bears. Some Bulls who didn't exit below 14 or didn't exit, sorry, on the close of 13 might exit below 14, and that causes the sell off on 15. At this point, we're back to the bottom of the most recent buy climax, which was the bar 10 low. So probably buyers pretty soon here, but still consecutive bear bars, so a problem for the Bulls. 16 is a big bull surprise. 16 was not really supposed to happen for the Bears. I thought it was possible we get some sort of bull bar and a second leg up, but I did not expect the bar to be this big and look this strong. And when you see this bar, any of the Bears who are short for any reason are starting to think they're probably trapped. So 16, I would say 60% chance of some sort of second leg sideways to up. And we've had only closes above the moving average so far today. And this is still a reasonably tight bull channel. And you know you have a wedge here, so a lot of good reasons to buy and go for the measure move up. If you bought, you get good follow through on 17. I think this is one of those trades on 16 where you do need a good follow through bar. If you get some sort of doji bar, it gets a lot more difficult because the risk is big and traders are concerned this is a trading range. They're buying above 16, hoping this turns into a bull trend, but they know that it's very possibly just a leg in a trading range because of how strong 14 and 15 were. So if 17 is not good follow through, a lot of traders will just exit at the market. And you can get another situation like this, right? Traders want good follow through. They didn't get it. They exit at the market, and that's causing 14, 15. Traders want good follow through. If they don't get it, they might exit. And instead, we get a good follow through bar on 17. 17 had something really good going for it in that it closed above the high of the wedge, the 12 high. So now we have consecutive bull bars, and they're breaking out of something, the wedge. So consecutive bull bars breaking out, good for the bulls, probably going at least a little bit higher. More follow through on 18, three straight bull bars, really strong for the bulls, and then bull surprise on 19. If I'm long at this point, I'm getting out on the close of 19. It's in theory reasonable to buy every buy the close bar, but this is such a climactic bar. And I thought, me personally, I wasn't looking at the open of the week. I probably should have been, but I was looking at the high of this bar because, it was a bull bar closing near its high, and some bulls who bought above it never had a chance to get out. So I thought we were going to go to here and then probably start to sell off and go, or not sell off, but go sideways. So for me, I think when you see 19 rallying, there's probably not much left to the upside for the bulls, and it makes a lot more sense to just get out and wait for a couple legs sideways to down. And I think 70% chance. Well, first like 99% chance, or not 99%, but 90+% chance that you're going to get a second leg from this. Probably like 95% chance you're going to get a second leg from this, and we're not just going to sell straight off. So some traders will buy it, some algorithms, and hold. But I think for the individual trader, what makes a lot more sense is to just get out because you have to have such a wide stop for that. I had someone ask me about tight stops, and I gave kind of a vague answer because it's a vague discussion. All of trading is. But I thought good examples of trades you could take with a tight stop. You could buy above 6, and if you're buying above 6, one of the ways to use tight stops is if you're taking a trade and your premise is that you've seen the high or the low of the day. So if you're buying above 6, your premise is probably that this is the low of the day. So your stop can just go here. And if you get stopped out, then your premise it was the low of the day is not valid anymore. So it's fine. And I thought a similar thing with 29. If you buy, actually, no, I thought the opposite thing with 29 because it could go below 29 and you're still valid in thinking we're going to get a second leg up from this. So I thought buying above 29, it made more sense to use a bit of a wider stop since we had an open gap. You can see bar 19 broke out above this entire wedge, and it left an open gap. So the traders who sold above 12 and tried to scale in got trapped. So on 29, I probably wouldn't use a stop below 29. I'd probably put a stop, maybe a measured move down to 29, so that the bears have to close this gap in order for the bulls to stop you out, which would mean that the small pullback bull trend is no longer valid. I thought it was hard to think of this as a small pullback bull trend because of how big, with a 3-bar pullback and then a giant bear bar on 26. So I thought small pullback bull trend was unlikely, but we did have an open gap here, open body gap, you can see, and then we had an actual open gap here and a pretty strong move. And this was a lot stronger than these. So I was kind of concerned that, or I was thinking that it's possible buying above 29, you might end up seeing some sort of small pullback bull trend. But anyways, I would buy, I got really sidetracked there, but I wouldn't buy above 19 unless you're willing to sit through just this, you pretty much have, if you're bought above 19, you pretty much have to sit through all of this or be really quick to get out and take a quick scalp. Same thing with 20 and 21. I wouldn't take any of those buys. I think you're buying way too high. If this happens to be part of the, I don't know, 20% of the time that it just continues and rallies straight up, someone else can make money there. I don't really need to. 20 and 21, good bars for the bulls, but really climactic. The risk is huge. So you see 22, I think if you're long, you just get up below 22 and you give it a couple legs sideways to down and look to buy a lot closer to the moving average because we're so far from the moving average at this point. 23, a big tail on the bottom. Some bulls are exiting. Some bulls are hoping that we're going to get back to the 21 close, which we probably will. I was really surprised we didn't get back to the 21 close later in the day. And I think it's because we tested the open of the week here. The weekly chart was really important because bulls were trying to get consecutive full closes above this breakout point, and you can see they failed to do it. So the open of the week was really important, and I think that's a big part of the reason why we did not test this bar 21 close after this rally. I thought really likely that with this rally, we were going to at least test up to here, but 57 was a surprise, and bears came in around the open of the week, and that's probably what caused traders on 58 to just exit. But anyways, 24, a bear bar closing near its low. I think it's mostly just bulls exiting, but this is a minor reversal. So since this is bulls exiting, there's no bears to sell, and that's why you get a bounce on 25. And anyone who was long for any reason sees a 3-bar bear pullback and knows that that the bull trend is probably over, and this is now going to transition into a trading range or a bull channel. And either way, they don't want to buy up here. They want to buy a lot closer to the moving average. So what are they doing? They're looking for just any sort of bounce to use to get out. And you get a bounce on 25, and most traders just say, good enough, and they flatten at the market and they exit. And that causes the huge bear bar on 26. So that I think is just bulls exiting. An inside bar on 27, good for the bulls, but I'm not buying above that. I would rather wait. Another inside bar 28. So we have an II 27, 28. It's a breakout mode pattern, and we're near the moving average. We should get a second leg up from 16 to 21. I thought the 21 close was going to be the magnet all day. So we should get a second leg up for the bulls. The overall, no matter how long we go sideways, if you look back to the last time it was clear, it was right here. So even through all of this, the bull edge dissipated a lot, but it was probably always slightly more bullish than bearish. Additionally, look at the good bull closes bulls were getting. 45, 47, 41. And, this bull bar. So it made me, all those really good bull bars closing near their highs after this was making me think we were going to continue to rally. 29, a bull bar closing near its high. It's a failed breakout below the II, which is relatively expected considering the bull strength. And, now we have a good buy signal bar after a pullback and the gap is still open. So a good buy above 29. We might go a little more sideways first because of how big 26 is, but we should ultimately rally. Disappointing follow through on 30, more of a doji bar. You can see bulls bought more of the 50% pullback of bar 29 instead of directly above it. 31, follow through for the bulls. It's good for the bulls. They're hoping, we're at least going to get back to here, if not this high. And we ended up just getting back to the sell climax high. A doji bar of 32. So this isn't ideal follow through, but you're probably not going to get ideal follow through buying above 29 with how big 26 was. So you have to think about your trade if you're going to take it. What should your follow through look like? That's the things that are important when taking trades to think about are what should your follow through look like and what is your premise. And, if you're taking a buy above a trade like 16, you should be thinking to yourself, I want a good bull bar on 17, or I want some sort of, decently clear follow through on 17, and you get it. And if you're buying above 29, you can't be expecting to get, a huge bull bar as follow through. It's probably going to be more sideways to up because your premise that we're going higher based off of the fact that 16 through 21 should get a second leg up is true, but 26 also exists and it's a really big bar. So we might have to go a little bit more sideways first. So you have to be thinking about your premise and what you need your follow through to look like if you're going to take the trade. 33, more follow through for the bulls, but a big tail on the top. It's okay to be long, but we might find sellers around the 26 high, most recent sell climax. More follow through for the bulls on 34, but again, we're getting relatively high in the range here. And it's hard to see, but it's kind of a wedge. I looked at it as 29, 32, and 34. You could probably also draw it 31, 33, 34. But either way, it's kind of a wedge. And so you get an inside bar 30, 35, which essentially is the signal bar for the wedge. And what do bulls want? Bulls want the breakout above the wedge and a measured move up, to maybe somewhere up here, or to at least get back to the 21 close. And the bears want the breakout above to fail. And you can see the breakout above ended up failing and we got the reversal down. Maybe, It was maybe 50-50 here. It might have been more like 60% for the Bears, with how big 27 was, or 26. And the Bulls, who bought above 29, what did they do? Well, they ended up scalping it with 5 points. You can see they made exactly 5 points buying above 29 rather than buying above 29 and buying more here, hoping that this was going to turn into a small pullback bull trend. They scalped out. And part of the reason I think for that is how big this big bear trend was. And with the size of, the bar on the daily chart, it just wasn't all that likely we were going that much lower. Do you sell 36? I probably wouldn't. It's not really a great trade. It's probably fine, but it's not really all that great. Follow through for the Bears, 37. Okay to be short, probably, but I think we're still always in long from this. I don't think this has changed that much. And it just looks like you're trading in the middle of a tight trading range at this point. 38, good bear bar, but I'm not selling it. To me, some bulls waited until they got 3 bear bars and then they just exited. And the bulls who waited until they got 3 bear bars and then exited is what's causing 38. Not as much bear selling. And if you sold for any reason, the target was probably the moving average. We haven't closed below the moving average yet today, so the first time we do that, bulls are going to be pretty eager to buy it. 39, a bull bar, but a big tail on the bottom, a big tail on the top. I think at this point, I'm not interested in doing anything until we get a small bar towards the bottom of the range to buy, a small bar toward the top of the range to sell, or some sort of breakout. 40, an inside bar. So again, I just think more sideways. It's big high. It's a high one for the bulls, but in a bear trend from 35 to 30 to 8, not really that good. And then a bull surprise up on 41. Some bulls might try to buy above 41. Any buy the closed bull on 41 got trapped, but I thought it was reasonable to, start looking to buy again because it was possible we started a second leg up and should at least get back to the 21 close. And instead, you got a big bear bar closing near its low on 42. Do you sell below 42? I personally would not. It might be a big second leg trap from the move from 35 to 38. And look at how strong 41 is. It's really unusual to get a really strong bull bar and then a really strong bear bar, and this just goes all the way down, especially considering the fact that we had this really strong rally. So when you have a rally that's this strong, the bull bars are going to be magnets. So 41 creates a magnet. And unless 42 is the start of a big bear trend, we're probably gonna rally back up to here at some point. And what are the odds 42 is a big bear trend? Well, I don't know, maybe 40%, but it might not even be that high. And it's a big bar with big risk, so traders don't want to sell with big risk with low probability. So it's not really a very good sell. It looks more like a second leg trap. And you can see they instead tried to sell the 50% pullback and then trying to scalp out. If you did sell below 42, 43 is not really good follow through. Again, if you're thinking about what do you want as follow through, you can't just sell 42 and think, well, I just want some sort of bear bar. No, you probably need a good bear bar closing below the 29 low and reasonably far below the 29 low for your premise to remain valid. So I don't really think it's all that good. And then 44, another disappointing bar. This is really not all that great for the Bears. It just looks like we're at the bottom of a trading range to me. The odds of a big breakout to the downside are pretty low. 45, a surprise bar up. I think it's because Bears exited. Can you buy above 45? I actually thought it was okay. I could be wrong, but I thought it was okay. The problem is 42, 43, 44 is enough for a second leg sideways down for sure. So you're buying against a reasonably tight bear channel from 35 to 44. And you're buying kind of towards the middle of the range, and the bar is decently big, so you might be risking a good amount. Something I probably did wrong today was thinking that we were going to get back to the 21 close. I was just very sure of it because it was such a strong rally that I thought it was very likely we were going to test the high. So I did take the buy on 45, and I thought my management could have been better. We see so we get entry bar 46, right? So when I saw 46, I was not surprised because I thought second leg sideways down from the move down to 44 because it was a decently tight channel, and 42, 43, 44 was 3 consecutive bear bars. So I thought some traders were smarter than me and they bought the 50% pullback of 45, but I wasn't that surprised with that follow through anyways. 47, a bull bar closing near its high, good for the bulls. You can, a lot of times traders look to buy the pullback and then they continue to buy and they're hoping to get up to here. So I wasn't all that surprised when we got 47, but 48 being a bear close was really disappointing. And I ended up sitting in the trade and I sat all the way and I ended up exiting in here because what I should have done, I'll get to that. I should have taken at least a piece off after 57, because 57 was a surprise. It was not supposed to happen. We were supposed to get here first. And then you get 57. So I think a lot of traders won 58. They thought, oh, screw it. I'm going to just take a piece off. And then when they did that, we got a disappointing bar 58. And then the rest of the traders hit the flatten button because they were just, no, I'm not interested in this trade anymore. I thought we were going to go here and it doesn't look like we're going to, and that's causing 59. So I think a lot of the same forces that caused 26 caused 59. So 48, a bear bar closing near its low, probably 2 legs sideways to down. I wouldn't personally sell it, but it's probably going to get a few legs sideways to down. Follow through on 49, a big tail on the bottom though. A bull bar closing near its high 50. Am I buying above 50? It's kind of the middle of a trading range, but it's a smaller bar, but you'd have to risk a lot, so it's not as good as it could be. 51, I think, is the second leg sideways to down. So any of the bears who sold, they scaled in higher and they used 51 to buy back their shorts, and then 52, a bull bar closing near its high. So the thing is, if you sold 48, it was probably more of a scalp, and your goal was accomplished. You probably, if you're a good trader, you probably scalped out somewhere during 49. I would not sell this because I don't think, I just think it's really hard to do. You got to be really quick to make decisions. And a lot of those traders, once you see 51, you have to realize your goal has been accomplished. You wanted a second leg sideways down, and you got it on 51. So there's no more edge left in this trade. So 52, a bull bar closing near its high. It's a smaller bar towards the bottom of the range. It is right on the moving average, which isn't good, but I think okay to be buying here. And you get a good follow through bar, 53. Some bulls buy the close. A sell off 54. Why? Because the bulls who bought above 47 scaled in lower, never had a chance to get out, and they used 54 to sell out of their longs. But instead of getting some sort of air move here, we got a bull close on 54, and bulls see 3 consecutive bull closes. What do? They buy the close of 54, and that causes the rally up on 55. More follow through for the bulls on 56. We're really close to the magnet. We should get there. But instead, we get disappointment 57, around 50% pullback of the move from 54 to 55. Or not around that at all. I don't know why I thought that. That must have just been maybe from the whole rally. Yeah, from the whole rally, a 50% pullback. And bulls, 57 was too big. I think once you see 57, so initially my plan was to take a piece off here and see if we got a big second leg up from this. But I think once you see 57, your plan should be to take a piece off here and see if we get up here or some sort of rally. Because 57, I think, negates the odds of getting some sort of big bull trend, because if we were going to get it, this should not have happened. And so what do traders do? Well, some of them buy the 50% pullback of this move, and then they use the rally up to 58, up to the 56 close on 58 to sell out of their longs. And like I said, the traders who did not sell out of their longs were hoping that 58 would close on its high, basically above the close of this bar, showing that traders, they didn't sell out. Instead, what they did, or they're hoping it would show that traders didn't sell out, and instead we would get a follow-through bar, and any of the bulls who did sell were trapped. But instead we got this, and so those bulls just gave up, and that's causing 59. 60, an inside bar, not as many bears left to sell. It's a good bar for the bears, and to me, when I see this, I don't think we're going here anymore. I think it's more likely that we're going to the 12 high, because this is now clearly a trading range day, and so we might have to close this gap, which we did end up doing, but it doesn't trigger. So inside bar, low 1, short 60, but low in a bear trend. Low in a trading range. I'm not doing it. 61, a bear bar closing near its, somewhat near its low, but I'm not doing that. I think it's too low in the trading range. And it just could be a third leg down, 57, 59, 61. Outside up, 62. Good for the bulls. Some might take the buy or buy a 50% correction. But again, I think it's one of those things where it's probably going to go sideways to up if we do go up. This was like the last gasp of air for the bulls, I think, 62. So occasionally you will get, I think, the rally here. But the problem with buying above 62 is you're buying the exact middle of the trading range. So that's really tough. Your entry price would be the exact middle. So it's tough to do. Disappointing bar on 63. And so the bulls who bought on 61 or 62 maybe scaled in 63 and used 64 to sell out of their longs. And then 65, a bear bar closing near its low. Can you sell 65? You probably can. You see that 50, 59 is a big bear bar closing near its low, and you get a 3-legged pullback, 60, 62, 60, 64. So you can argue that second leg down from 59 could start now after 3-legged pullback. But to me, I don't know. At this point in the day, I was getting pretty resistant to taking anything because I was thinking we were starting to go sideways, and we might just go sideways the rest of the day. I think if you're taking it, your premise is we're getting to the 12 high. So for me, if I had sold 65 and I get this follow through, I'm probably, it's not a coincidence that if you sold below 65, your exact 5-point scalp was the 12 high. That's the algorithms doing that, creating a reasonable equation and reasonable profit target. So for me, I think if I'm selling, I'm scalping out with 5 points and just not worrying about trying to catch the rest of this when a couple points lower, but I would just get out here. And the traders who didn't get out and were hoping it was going to keep falling, they saw the big tail and they were then disappointed and they just exited, and that causes 68. If you buy above 68, possible bear trap. Maybe we should get back to the 28 low or the 29 low, the breakout point. So we broke out below that and we should test it. You can see we did on 69 and found sellers, but I don't really want to take any trades this late. The big fight was over the open of the week today. So I thought it was possible we tried to get a rally back up towards the open of the week, but I thought that if we were going to do that, it probably would have happened, here. And this was, too much. So I thought it was pretty unlikely we got a big rally back up here. You can see bulls were trying to get a rally, but just were never quite able to get anything good going. So for stop orders, I think 6 was okay, 10 was okay, 16, 17, 18 by the close. Theoretically by the close 19, but you're playing with fire. If you buy above 19, 20, or 21, you exit below 22. And it really sucks mentally to buy above the bar like 21 and just have to exit with a loss when any bull who bought at any other time didn't lose money and you did. And I've done that before and it's not a good feeling, but you got to get out below 22. You can't just sit in the trade, because if you do that, you're inevitably going to end up getting out a lot lower. Unlike the close of bar 26, right where there's no bears left to sell. That's when a lot of beginner traders would see this and be terrified and then just exit the trade. So you really, if you buy up here, just get out there. I wouldn't sell any of this. I thought 29 is a good buy. Probably get out below 36 or 37. I wouldn't take this sell. It might be marked. It's a really big bear bar, but I just thought 41 was so strong. I was really confused as to why we would have a bar like 41 and then 42 would work. 45 was probably okay, but it's going to go sideways first. So tough to take. 52 is good, 53. And then theoretically, probably 65. So on the daily chart, if you've been watching my videos, I've been mentioning that I thought we were going to close this gap. It was an exhaustion gap. And you can see we did, and we found buyers there, and that's what's causing this bounce. Generally, when you close gaps, you're going to find, if you close a bullish gap, you're going to find buyers there, because the traders who sold here expecting to make money scaled in higher, and now they want to buy back their shorts, and that's what's causing the bounce here. This is a big enough bar to make me think that we're at the top of the trading range. So, I mentioned when we were over here that I thought we were going to create some sort of trading range. I did not think we'd go all the way down to 5,000, though I'm not that surprised that we did. So I think, to me, obviously we created the bottom of the trading range, and I think with this bar, we have now essentially created the top of the trading range. We might go a little bit higher, but I think more or less the range is going to be, within this general area for a little while. And we'll probably go, something like this. We'll go sideways here for a while. I'm not sure how long, but we'll probably go sideways here for a while. I expect we're going to start to go sideways to down relatively soon here. And who knows if it's a trading range, right? Gaps close. So it's possible we close this gap. Possible we close this gap. I wouldn't be surprised at all if we did that. But I think the bears need to get a better setup first. For the weekly chart, again, I thought it was really important that we were not able to close above this high for the second consecutive week. The bulls, what they wanted to do was they got a good bull bar. It wasn't a great bull bar, but it was a reasonable bull bar, and it closed above the high of here. And they wanted consecutive bull bars closing above the breakout point. But it was less likely after these 3 straight bear bars, which is part of what gave the bears confidence to sell around the open of the week today, betting that it was not going to close that strong. So this, to me, signals probable trading range. These signal probable trading range. I think probable trading range. On the monthly chart, we're getting, we got a breakout above last month's high. This is pretty solid for the bulls, but I think this is going to get a second leg sideways to down. So expecting a little bit more sideways here. And yeah, that's the day.